It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. You know, I talk a lot about setting up these high cash value policies to earn dividends, then setting up the bank lines of credit to access funds from them to get the positive arbitrage. But this past week, I've had questions from a couple of folks that I thought was interesting. And it was, I hear you talk about setting up new accounts, new policies and all that quite a lot, which I do, of course. But do you work with folks who already have one? And the answer is yes, I do. In fact, if you happen to have a policy that has cash value, you should contact me at yourpersonalbank.com because there's a couple of things I can most likely do for you. One of them is if you want to grow cash value, we can adjust. There's adjustments we can make, tweaks often we can make to maximize the efficiency of that policy so that you can earn more cash. Most people don't realize that's even possible. So it's one of those things that we can take a quick look at it and I can determine whether that's the case. Again, to maximize, it's all about maximizing cash growth, right? So if you already have one, then let's look at how we can maximize the cash for you. And maybe you've had this for decades even. You might have had it a few years. You might even have it for decades. Whatever. It doesn't matter. We can often maximize the efficiency. All right. That's one. Two, if you have a policy loan or considering taking funds from it, these policies are set up so, most cases you can access funds from it through policy loans. That's the most common way folks access it. Now, the positive is you have access to funds if and when you need them, typically on a tax-free basis, high liquidity, all that's great. But the problem is, depending on the company, the interest rate that most of these companies charge is typically around 5%. Now, most companies right now are paying 5 to 6% dividends. The better ones are. Some are even in the upper fours. But anyway, the point is, if you're earning 5-6% dividends, let's say, and you access funds from these policies that are in place, well, you might be breaking even. You might make even a little bit of positive arbitrage, possibly even 1%, but that's not a whole lot, obviously. So I was speaking to a gentleman today, literally, and he has a policy that's paying him 6% dividends. He's had it 20 years. He's got a bunch of cash value in it. He accessed funds from it to purchase a house, actually, which is not uncommon. He's earning 6% dividend. He's getting charged 5% on his loan. So he's moving forward at 1% positive arbitrage. That's fine. But what I pointed out to him is, hey, look, let's set up a bank line of credit against this policy. And the rate that they're going to be able to charge him for this particular gentleman is 3%. Most folks I can get 3 to 3.25%, depending on their situation, how much we're dealing with. So the question for him was really quite simple. If you're earning 6 dividends and you access the funds and they're charging you 3% interest on the bank line, what's your money doing? He's like, well, it's growing, still growing at 3%. And I used the money to purchase this house. I said, exactly. And the bottom line is this, and we were talking about a significant enough amount of money that in his case, he was getting thousands of dollars a year, positive arbitrage now. If we make this switch, and there's no cost, there's no fee, and he actually owns 3 properties. He's looking at getting a 4th, and I showed him where he would be able to get enough positive arbitrage and cash flow from the rentals that it covers his expenses. He could potentially retire if he wanted to. So, folks, this is huge. If you have a policy, contact me, okay? Contact me at yourpersonalbank.com so I can take a look at it and show you how to maximize efficiency, like I said, and also how we can create positive arbitrage, free up the money in the policy, right? Free up the cash so that you can use it for whatever purpose you want to use it for, but also gain positive arbitrage at the same time. All right, so like I said, contact me at 866-268-4422 or yourpersonalbank.com. It's really amazing how much of a difference I can often make for folks. And again, this is money that's, in many cases, I'll give you another quick example. A gentleman I met last week who had a couple of these policies. He'd been building cash value. He'd been building cash value in these policies for, a decade or two. And he's like, yeah, I don't want to access them because what's the point? If I take a policy loan, I'm going to get charged about as much as I'm earning, so the money stops growing. I said, I understand. But I want to use the money. He wants to do some real estate investing and some other things. And I said, look, if you bring in the bank line, you can still pick up 2-3% positive arbitrage and take that money, invest, and make more. So it frees up dollars. He loved the idea. He's sending me the information. We look at the current reports. We do an in-force illustration, if you're familiar with those terms. And we look at it, and I'll share with them, look, we'll go over the numbers. It's not, you don't have to listen to me, okay? You don't have to trust me. We're going to let the company generate the numbers, your company, and we're going to compare those numbers and let the numbers talk. It'll be a no-brainer. It'll be very obvious what you should do. And like I said, going back to this first example, was this gentleman who had a policy, had taken a policy loan to purchase the house, and he's earning 6% dividends. He's paying 5%. He's getting charged 5% interest on the loan. I said, here's a way to look at it. If you were going to go buy a house, let's say, and you were going to get a loan for that house, and you went to 2 lenders, and everything, the amounts were the same, the terms were the same, everything was the cost of the loan, everything was exactly the same. And one lender was going to charge you 5%, and the other was going to charge you 3%. Which loan are you taking? I mean, that's a complete total no-brainer, right? And he laughed. He said, that's obvious. I take the 3% loan. I said, that's exactly what we're talking about here. There's no cost. There's no fees. There's no points for these lines. Okay? Nothing. So basically, in his case, we dropped the cost of borrowing by 2 points. Folks, the difference for him was like $6,000 a year. More in his pocket as a result. Okay? That's significant, folks. And many of you listening right now have the exact same kind of situation. So again, I can't stress enough. If you have a policy that has cash value, you need to contact me at 866-268-4422 or yourpersonalbank.com so I can show you how to maximize the cash growth efficiency on it. All right? And then secondly, if you have a policy loan, you're borrowing money from one of these because for whatever reason, you need to contact me also because I can reduce your cost of borrowing, in most cases, quite significantly, like almost half. If you can reduce your cost of borrowing by nearly half, well, why wouldn't you do that? And again, with no cost, no fee, no points, no nothing. Another way to look at it is if you have a mortgage and your interest rate is 5%, for example, and then you have the opportunity to refinance at no cost and go to a 3% loan with the same total amount owed, okay? So you didn't increase the amount owed or anything else. You just reduce the interest rate. You reduce the cost of borrowing. Folks, why wouldn't you do that? I mean, that's just financially, that's one of those financial no-brainers. You see what I'm trying to say? And so again, I'll say it one more time. Contact me at toll-free 866-268-4422 or yourpersonalbank.com. And I'll be happy to compare the numbers and show you what we can do. Look, if you set up the bank line, I don't get anything for that. I mean, I'm going to steer you to the best banks out there, the best options for you, to, again, depending on the situation, how much you have and various things. I've worked with and how should I say, negotiated, we'll put it that way, with a number of these banks around the country to offer the best rates and best offers available. You can't go, that's the other thing probably you need to understand. You're not going to be able to go down to your own local bank or any of the national banks for the most part and say, hey, I have cash in a policy and I want to take a line of credit against it. You could do it with your house in most cases if you have equity in your property, but you're not going to be able to do it if you have cash in a policy in most cases. The reason? Most banks don't offer this kind of lending. Folks, it's a specialty area. It's an area of specialty in the lending industry. There are literally a couple handfuls of banks that I'm aware of, and I assure you, I talk to a lot of them on a regular basis, on a weekly basis, and I ask them who else is out there, and they all keep giving me the same names. So they're not aware of anybody else, okay? There's probably 8 or 10 banks in the country that offer this kind of lending. Some are more competitive than others, and I've been able to identify the most competitive ones. I actually work currently with 3 different banks. And again, they offer the best rates, the best situation And it all depends on a person's situation, how much money we're talking about, the type of policy, and all that kind of stuff. All right? And the rates, by the way, range from 3% to 3.95. So, again, depending on your scenario, I'm going to tell you straight up, it's going to be 3 to 3.95. And if you're borrowing money or looking at borrowing money, taking a policy loan from one of these that you may already have, or maybe if you just set it up even, that's fine, doesn't matter. If you just set it up or you've had it for decades, doesn't matter. If you have taken money from it or you're considering taking money from it, I'm going to be able to reduce your cost of borrowing, because I'm not aware of any insurance company in the country right now that is offering policy loans with that low of rate. There may be one, but I'm not aware of it. And if that's the case, geez, I want to know about it. You know what I'm trying to say? So, again, I can help folks who already have a policy, who already have cash value, whether they set it up last week or 20 years ago or longer even. Doesn't matter. I can help you increase the efficiency on your cash growth. I can help you free up the equity, the cash in there to be able to use it and get positive arbitrage if and when you need it for whatever purpose you see fit. Whether you're looking at paying off debt, purchasing items, taking the money to invest, supplement retirement, it doesn't matter. I can even show you how to access these funds, free up the equity in these policies, okay? The cash continues to grow, for example, and you could supplement retirement and never pay the loan back and increase the amount of money you have available each and every year, okay? The last question I get on this quite often is, do you work with whole life or IULs or this or that? Folks, I work with all of them. It doesn't really matter. We have options for all different types of policies, which again is very unique, very rare. Most insurance agents, financial advisors that you talk to that deal with insurance at all, if they do at all, okay, they typically, in most cases, work with one type only, because that's in their wheelhouse. That's, if you know what I'm saying, that's their comfort zone. I'm agnostic. I don't really care. My opinion is it depends on the person's situation on which product or tool fits them the best. So we work with all of them. So whether you have an IUL, a whole life, or something else that has cash value, UL, whatever, that has cash value, and you want to learn how to maximize efficiency, and you want to learn how to access funds from it and create positive arbitrage, contact me at toll-free 866-268-4422 or yourpersonalbank.com. Stay tuned in the next segment. We're going to talk about some other things that have come up recently, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today I was talking about some of the questions that have come up this past week, actually. Again, if you missed in the first segment, go to yourpersonalbank.com. You'll check it out. But what I was talking about, you can listen, by the way, you can listen to any of the previously recorded shows from the website. And there's there's almost 2 years of shows on there with different topics. And so if there's anything you have a question about on how this works or whatever, go to yourpersonalbank.com, click on listen to previous shows. You'll see each show with topics and various things I talk about. And there's tons of content there for you to listen and learn and get your questions answered. Of course, you can contact me, yourpersonalbank.com for questions too, or toll free 866-268-4422. In the first segment, I was talking about if you already have a policy, how I recommend contacting me to maximize efficiency to grow your cash if that's what you want to do. And two, we can also show you how to access and your liquidity, free up the monies, free up the equity, the liquidity there, so you can use it and still get positive arbitrage using bank lines. So look, you don't have to fund a new policy. You could have an existing one and make all this work. So again, contact me. But the second thing I want to touch on today is I had a great question, in fact, today by a new client. And he was saying, hey, I understand I'm funding this policy to maximize dividends. His case, he's getting 5.75 currently. He's with the company, has never paid less than 5.75. I don't know how long, more than 26 years, has never missed a dividend since literally before the Civil War. They've already come out and stated they're going to pay 5.75 in 2022 and 2023. Folks, they're the only company I'm aware of that's committed to keeping that level of dividend for the next couple of years, next 2.5 years actually, with this low interest rate environment. I mean, frankly, that's incredible. If you understand how conservative many of these insurance companies are and CFOs and things like that, for them to come out and state they're going to continue the current dividend level at 575 for the next 2.5 years, folks, that is super powerful because we're in a huge, tremendously historic low interest rate environment. I don't think that's a secret for anybody. And in fact, the Fed came out this week and said they're going to continue the current low interest rate environment at least through the end of this year and continue what they call bond purchasing, printing money. Okay. That's a whole nother discussion, which is going to ensure this low interest rate environment is going to continue for the foreseeable future until the Fed changes their policy. So for them to come out and say that and commit to that 575 dividend for the next 2.5 years through 22, and like I said, probably 2023 also, wow, that's powerful. Obviously, with the low interest rate environment, the bank lines are going to stay there too in the low end. And I've told you, most of my clients get 3 or 3.25%. So if you're earning 575, for example, and I can get you 6, by the way, depends on the situation today. But if let's just say you're getting at least 575, and then if you leave it there, you're getting that on a guaranteed basis, tax-free if we set it up properly, which of course we will. And if you leave it alone, that's your money's growing, right? And if you decide to access it for whatever reason, and you're earning 575, say you're getting charged 3.25, for example, what's your money doing? Well, you're making 2.5% positive arbitrage. And frankly, that's not going to change anytime in the near future, not for the next several years, at least, unless something dramatic out there changes, right? So I had a great question. That's what I was leading to today. Gentleman, he's funding this policy. He's excited about it. He's going to take it, and he's actually going to access funds and purchase another property. He's a real estate investor, and he's going to, generate cash flow from that. He's expecting about a 10% rate of return. That's historically what he's been getting. And he's going to pick up the 2.5% positive arbitrage. So now his return is 12.5 versus 10. Awesome. With some tax benefits and some safety and all that good stuff. Well, here's the thing. He asked the question, well, what if at some point there's another company that offers a better dividend, or I decide to take my money and go elsewhere? What are my options? And here's the beauty. There's lots of options. First of all, and I'm going to go through it just like I did with him. First of all, could you close it down and take your cash and go elsewhere? And the answer is yes. Now, in the first 3 years, you might have you might not be able to get 100% of the money. So that typically is not the best option. Most of my folks are access to cash is anywhere from 50 to 85% day one. These folks are in the 85% range. That's where most people are. But anyway, my point is simple. You get most of it, but not all of it. I wouldn't recommend closing it, but that is an option. The second option, which is far better, is because we're setting up a bank line of credit, and you can access the funds at a much lower rate than the dividends you're earning. The smart thing to do is just take the cash from the bank line, and now the cash in the policy is going to continue to earn dividends and grow, compound every year for the rest of your life. So what ends up happening? You get more and more money each year. Your money continues to grow. Even though you borrowed it and took it, you're still getting, say, 2.5% positive arbitrage. You're going to get more and more money each year. So eventually you'll have all your money back and then some, right? By a long shot. All right? There's a third option. Let's assume for a minute. Now, the company I set them up with, I said earlier, they've had a long track record. We're talking about since before the Civil War, never missing a dividend. They've been among the top dividend payers over the last 26 years in a row. I'll show you the charts. I'll show you who's paying what. I'll show you all of that, okay? So you know exactly who and why it makes sense. But let's assume something happened, their dividend dropped for some reason, even though they've committed to it for the next through 2022 and 2023. Let's assume another company came out with a better dividend and you wanted to switch. Well, guess what? There's something called a 1035 exchange, which works similar to a rollover. It's a tax-free exchange. We've done many of those where we've taken funds from somebody has a policy from another company. The dividends are subpar. The growth is subpar, whatever. The way it's structured is subpar. And so we run the numbers and show how to maximize their cash growth, significantly more. By the way, most people increase their cash growth by, on average, 20-30% per each and every year. I've had folks increase by 50%. Okay. These are not small increases of cash values and cash value growth. They're significant. Like I said, the 20-30% range is the norm, and I've seen much higher. But we've taken it from the subpar, companies offering a subpar dividend, and put it to a much better dividend. And we can do it on a tax-free basis through something called a 1035 exchange. It's the IRS code 1035. That's why they call it that. It's been available for I don't know how long, but we do them. I do them probably almost a weekly basis. 1035s are very common. And again, the funds, like a rollover, move over from one policy to the other on a tax-free basis. There's no penalty. I mean, whatever. There's no extra cost to do it. It's like a rollover, like I said. Now, there's some other things we got to consider. We'll look at it. We'll run the numbers, obviously, to make sure it makes sense. But I've had folks who've had policies as long as 10 years and then look at doing a rollover from major insurance companies that you would think but they're dividend subpar, frankly, and they came out cash ahead, money ahead by doing the 1035 exchange. So again, if you happen to have a policy, as I stated in the first segment, I can show you how to maximize the cash value. You might have to make some adjustments to maximize it so your cash grows faster. We can set up a bank line to give you access to the money and still get positive arbitrage if you decide you want to access funds, or if you already have. That's fine. We can take care of the existing loan, have the bank pay it off, and lower your cost of borrowing rate. If you're in a company with a subpar dividend, we could do a 1035 and increase your dividends, increase your cash growth, and with no tax cost. So there's lots of options. So stay tuned in the next segment. We're going to talk about some more questions that I've gotten on existing policies, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And, well, today's evolving into what do you do if you have an existing policy? So I've gotten several questions from folks. If you've heard the first couple segments, if you already happen to have a policy, maybe you just set it up, maybe you've been funding it for decades, you have a cash value, or you're building some cash value, how do you know it's, growing the maximum efficiency? Well, unless you got a second opinion from somebody else, you don't. So again, I would really encourage you to contact me at toll-free 866-268-4422 or yourpersonalbank.com. And what I'll do, I'm going to tell you to do is contact your existing company and request an in-force policy illustration. That's the term. It's called an in-force, IN-force policy illustration. And what that is that's the company, and it's done by their actuarial department. So these are quite accurate by any company you work with, and it's their best estimate of what they think the policy is going to do going forward. So we're taking the company that you're with, their information, their numbers. You can email that to me. You can email that to me at Ference at yourpersonalbank.com if you'd like. It's FERENC at yourpersonalbank.com. I'll run an apples-to-apples comparison, and I'll show you whether doing a 1035 exchange, which is a non-taxable event, makes sense or not. The numbers will tell us. It's not going to be my opinion. It's going to be based on what your company tells us. We're going to compare insurance company to insurance company numbers, the actuarial departments of each company. Again, they're extraordinarily accurate. And let's let the numbers talk. That's why I always tell people, you don't have to believe me. Heck, you don't even have to like me. That's fine. Most people do, but you know what I'm saying. We're going to let the numbers talk. We're going to let the numbers decide if it makes sense for you to tweak or adjust your current policy because you want to tweak it to maximize cash value, if that's your goal. If you want to increase the death benefit or maximize that, we can adjust. That could be adjusted oftentimes, okay? It all depends on your situation, of course, but we can look at those options. But is your policy growing at maximum efficiency based on the current tax rules that are in place? And interestingly enough, in most cases, when I do these comparisons, the difference in cash values is often 20-30% more. In other words, your policy is going along at 80% efficiency or 70% efficiency of what it could do. All right? Now, if you had 20 or 30% more cash each and every year for the rest of your life, folks, that's a lot more cash. I don't care how you cut it, okay? That's a lot. So what I'm saying is the differences that we see when we compare these policies is huge often. And I've seen 50% differences, just so you know. So it's worth contacting me at toll-free 866-268-4422 or yourpersonalbank.com to get that no obligation third-party comparison. Got nothing to lose, right? Secondly, I can then also show you how to, if you want to access funds from it, we can set you up with the bank that offers the best rate, the best line of credit based on your situation, based on how much funds we're dealing with, the type of policy and all that. Depending on whether you have a whole life policy or an IUL or UL, or if it's front loaded, it's a MAC, non-MAC. All these are different factors that come in play. Different banks offer different lines for different type products, okay? And if I just threw up a bunch of technical jargon, most of you won't know what all that means. A few of you will. What I'm going to say is I'll explain it to you so you understand what type of policy you have, its strengths and weaknesses, okay? Again, I'm agnostic. I don't really care. I don't have a preference of whole life versus IUL or UL or any of that, unlike most financial advisors or insurance agents who tend to have built-in biases, is what I find. They love one and hate the other. It's frustrating, in my opinion. It's not about what you like as an agent, as an advisor. I tell my agents and advisors that all the time. I've said that for a couple decades. It's about it's about the needs of the client. What's best for the client? But we can look at, it doesn't matter, and then we can compare it and show you how to maximize efficiency, and then show you how to free up the funds in it, because a lot of people who have cash in these policies, really don't have any way of accessing the funds, because if they do, the insurance company is going to charge them interest. And oftentimes the interest they charge is as much or more than what they're earning. So if you did take money from it, yes, you could take money, but it costs you. Or at the very least, you're not making, you lose all the gains. You're getting charged as much as you're earning, so you're not going anywhere anymore, right? I'll show you how to create positive arbitrage. In other words, I'll show you how to access funds from it, and your money will still grow. You'll still keep the difference. And most of my clients are making 2.5-3% positive arbitrage in most cases. So even if you spend the money, you're still making more, right? Which is better than interest at the bank these days. So like I said, contact me at toll-free 866-268-4422 or Your Personal Bank for more information. Yourpersonalbank.com, sorry. And stay tuned in the last segment, because I'm going to cover a few more things for folks who have existing policies, what they can do to maximize them.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we're talking about folks with existing policies with cash values. You know, I found that most advisors, most insurance agents don't want to talk about that, or rarely talk about that, because, well, you know, we always want to sell a new policy, right? I mean, somebody wants to make a commission. I get it. But, you know, there's a lot of folks that have these policies that they've funded for, sometimes they maybe just set it up, or they've been funding it for decades. And I've had actually two people I ran across this week that literally asked me, hey, I've been listening to your show. Do you work? You talk about new policies like most people do, but do you work with folks that have existing ones? And the answer is absolutely yes. What I can do, and I've been talking about this in the previous segments, is we can compare what you have. We can maybe what you have is the best thing you know the best thing available. And if that's the case, I'll be able to show you based on the numbers that what you have is the best thing available. Or is there another option that might make more sense? And if we, you know, say through a 1035 exchange, which is a tax-free exchange similar to a rollover, that might make sense. It might not. My point is, I will show you the numbers from the old company, from the new company, and you'll see it'll be from the actuarial departments of each company, not from me. These aren't numbers I come up with or any other advisor comes up with. You want the actuarial numbers from the companies. Those are the guys, those are the folks that are the most accurate, okay? So there's no games being played, if you know what I'm saying. And then you can really make an intelligent decision because, well, the numbers talk, right? The numbers will tell us the story. Or is there some tweaks or adjustments we can do to salvage what you have or increase its efficiency, right? And I'll be happy to do that and show you that because, well, it means more money to you. And oftentimes when we look at these comparisons or increasing the efficiencies and stuff, we're often looking at 20 to 30% increases in cash value each and every year. Folks, that's for the rest of your life. The differences in most cases is not small. In most cases, it's significant. It's like a lot of people look at the comparisons when we do these and they're like, wow, holy cow. And they're like, what do I need to do to switch or adjust this or do whatever, right? It just totally makes sense. So again, contact me at toll-free 866-268-4422 or yourpersonalbank.com. I'll happily do a no-cost, no-obligation comparison, apples to apples. You'll see what I'm talking about. We can meet in person if you're in Phoenix. We can meet online. Well, even if you're in Phoenix, we can meet, through Zoom call, whatever we need to do. My point is, you got nothing to lose. The only thing you have to lose is, well, making more money on the policy you have. The last thing I can do, and this is something very, very few people have available to them who have a policy with cash value, is being able to access the funds with a positive arbitrage. In other words, most policies allow you to take policy loans. And maybe you've already taken some policy loans. You've taken some funds from the policy. That's not a problem. The issue is, in most cases, most companies charge as much in interest as what you're earning, sometimes more. So if they're charging more than you're earning, you're going backwards, right? If they're charging the same, you're marking time. I'm going to show you how to move forward. Positive arbitrage. Earn more in dividends than you're getting charged, so your money still continues to grow even after you access it to use for whatever purpose you want, supplement retirement, invest, buy things, whatever it is. I'll show you how to do that. Okay? Again, no cost, no obligation, and we'll let the numbers talk. We'll let the numbers show it, okay? And if you need to make a switch, we'll share with you why it makes sense to make a switch to be able to accomplish this, all right? Now, a lot of people say, well, this sounds great, but I'm too old or I've had this too long. No, like I said, in most cases, I can show people one or more ways of increasing the cash by oftentimes 20, 30% is the norm. And I've seen upwards of 50% increases, folks, okay, in cash each and every year. So this is no small thing. In fact, I met with somebody today, as I stated in the first segment, who he has a significant amount of cash in policies he's been funding for 20 years. He accessed the funds to buy a house. The interest, the dividends he's earning and the interest he's being charged, he's fortunate. He's actually still earning more in dividends than he's being charged. He's got a 1% positive arbitrage rate. In other words, he's earning 1% more in dividends than the interest rate he's being charged, which is one of the better situations out there. In fact, one of the best from an insurance company standpoint. Okay? His case, he was earning about $3,000 a year in positive arbitrage. I showed him by adding the bank line, we're going to get him $9,000 a year in positive arbitrage. Folks, that's an extra $6,000 a year for doing nothing. Fill out a form, submit an app, and he's going to make an extra $6,000 a year. He's going to make $9,000 a year instead of $3,000 a year. Now, he happens to have 3 houses and looking at purchasing a 4th. He can multiply that because he's doing this through properties. I said, now multiply that through all your other properties. And let's say you're making $9,000 a year positive arbitrage through each property. 9 times 4 plus the rental income on the 3 properties that he's renting. That adds up to enough money him and his wife could retire if they want to, which was very, very appealing. And like I said, folks, he set these policies up 20 years ago. He funded it long before I ever met him. But I showed him how to increase the efficiency of what he's doing. And we're increasing the income to him now by like $30,000 a year. Just by filling out a couple of forms. Now, do I make anything from setting up the bank lines and all that? No. Is it better for the client? Absolutely. Why would I do that? Well, it's very simple. I showed him how to increase the efficiency and get access to his funds of his existing policy, right? Well, then his next question was very obvious. He goes, well, I'm looking at purchasing this other house. I've got some cash freed up to do that. What if I set up another policy with you and then did it this way and used the bank line and all that and created another $9,000 in positive arbitrage plus the rental income? Of course, obviously that works. What happened? Well, I set up a new policy. I get paid a commission, right? Like any financial advisor or insurance agent. If a financial advisor or insurance agent recommends a financial product, they're getting paid somehow, right? I mean, most people understand that. So I helped the client, put him in a much better financial situation than he was. He's tickled pink. He's happy, right? He obviously wants to do more. Was that hard for me to convince him? No, he asked me. You see my point. If I treat people right, help them, improve their situation, and give them good advice, treat them like truly as an advisor, not a salesperson. I'm not trying to sell a product. I'm trying to improve your situation by educating them, much like I do through the radio show, as many of you know. It obviously leads to new business, and if that makes a win-win for everybody. I love that. I love win-wins. I love seeing when a person's financial situation gets improved. Folks, I had lunch with him today. He was excited. He walked away, says, "Yeah, I'm going to get you I'm going to get you this policy statements because that's what I'm going to need from him. I'm going to send him the forms to submit for the bank line. This will be completed in the next week or two, and it's super simple." And he's like, yeah, and he says, then as soon as I get the funds for that other property, then I want to set up another policy and do it again with you. The guy was excited, and rightly so. And that's exciting for me too. It's fun. I have fun with that. So again, it's like the light bulb came in on, and I said, yeah, think about how that can work. And he's like, holy cow, this is awesome. He's already basically doing it. I just showed him a better way to improve efficiency, again, by bringing the bank line in, which is rather unique, folks. There just aren't many people, there's hardly anybody out there, who's educating or dealing with folks, showing them how to set up high cash value policies to earn dividends, and then turn around setting up bank lines to create and allow them access to the funds, day one, the vast majority of the funds, and create positive arbitrage. Those of you that are more sophisticated people that understand positive arbitrage, they say to me all the time, if I can get 1%, if I can get any positive arbitrage, that's more money in my pocket. I said, exactly. Any positive arbitrage is positive, just like it says in the name. It puts more money in your pocket. Your money earns more interest for you. There are a number of people out there who hear the term positive arbitrage, and they kind of shy away from it, or maybe scared of it, or back away from it because they think it's some big complicated financial concept. Folks, it's not. It's actually very, very simple. It's one of the most simple financial concepts out there that exists. Positive arbitrage is nothing more than if you have some funds invested somewhere and you're earning a certain interest rate, and then you decide to you borrow against it using a bank line of credit or some kind of lending tool, and the interest you're being charged is less than what you're earning, you keep the difference. Folks, that's it. It's that simple. That's positive arbitrage. And that's what I show people to do every single day of the week. There's a lot of other ideas out there with premium financing and all these other things that can get really complicated. There's no reason to get all that complicated and do that. If you have some funds, fund a policy to gain dividends like anyone would do. Okay? It's quite simple. You're just investing money to make money, right? To get a dividend, earn interest. It's no more complicated than that. And then you decide, hey, I want to access funds from this. Now, some people do it right away. Some people do it years later. And you set up a bank line to access the funds because the cost of borrowing is less than what you're earning. And the cost of borrowing from a bank, historically and currently, is lower than the cost of borrowing from the insurance company. It's just that simple. As I stated in a previous segment, if you were going to get a mortgage, buy a property, and everything was equal, and one lender was charging 5% and the other was charging 3%, which lender are you going to choose? I think that's 100% would choose 3%, the lower rate, right? The lower cost of borrowing. And if you're earning 5.75, for example, like many of my clients are doing now, between that and 6%, by the way, and you're getting charged 3 to 3.25, which is most common, what's your money doing? You're earning, keeping the difference. And like I said from the beginning of the show and all the way through it, is whether you set up a new policy or you have one already, and whether you set it up yesterday or 30 years ago, I don't care. If you've got some cash value, we can do this and get you that positive arbitrage if and when you decide to access monies from it, when you see fit. I mean, I have one last little thing I'll share with a client I spoke to last week who's been a client of mine for the last 8 years. They've been funding their intention was to use it as a supplement retirement tool. Fine. They had no intention of pulling any money from it. They haven't. They've been funding this for the last 8 years. Now they're retired. They're wanting to access some funds from it. So what did I tell them to do? I said, let's set up the bank line. Because do you want to access the funds from a policy loan and pay 5%? Or would you rather set up a bank line and interest rate be charged as 3%? Well, that wasn't hard to figure out, right? So they set up the bank line, no cost, no fees, no points. And they're going to get an automatic deposit right into their checking account every month to supplement retirement. And in their case, their money's growing about 2.5%. The monies they're spending, they're using, are still going to grow at 2.5% each and every year based for the rest of their lives based on the current rates and historically based on the historical rates. So again, folks, it just puts more money in your pocket. If you want more information, contact me at toll-free 866-268-4422 or yourpersonalbank.com. Again, it's 866-268-4422. If you have a policy or you want to look at setting one up, it doesn't matter. If you have one, we'll compare. We'll show you the numbers. We'll show you how to maximize efficiency, maximize liquidity, access of the funds, and put more money in your pocket so your money goes farther and it enhances your financial future going forward.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.